The longer the Bank of Canada waits to cut rates, the harder the Canadian economy will fall. That is the headline of this video. I'll be reacting, and it's an interview with David Rosenberg, who is quite popular on the economy side and on Bay Street. And if you are looking for some help on how to navigate this real estate market in 2024, and you want to chat with me about what you're planning to do, or just like tactically speak about if what you're trying to do makes any sense, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and a question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and if you're enjoying the content I'm putting out there, do me a favor and like and subscribe to the Prime Properties channel. Now, we're going to be reviewing this interview from BNN that has David Rosenberg on, and I'll just give you my kind of feedback as the interview progresses, and I'll be reacting to this because I haven't seen this yet.
By one of the most quoted Bay Street economists, David Rosenberg. He's the founder and president of Rosenberg Research, and he'll be sticking around with us through the half hour. David, it's always nice to have you with us.
Thank you, sir.
Great. Well, you'd been pretty cautious, I know, in late 2023 on what might happen to Canada's economy this year. What's your current assessment of what's happening?
Well, really a lot more of the same. And when you're taking a look at 2023, the big story is the wide divide.
So I do read some of his work, and I'll put it up somewhere over here, but I'm pretty sure he said in 2023 we're going to have a recession, as along with a lot of other economists or research firms. Now, what I will note is that pretty sure we were in a technical recession, but then the the government of Canada revised its Q2 GDP so that it's neutral at zero instead of a negative amount, which technically took us out of a technical recession. But I would say we're in one right now. And if Q4, that we should be getting soon, prints as a negative, we're in a technical recession. So we'll find out soon.
Between economic activity and what's happening on population growth. So, you know, you mentioned that population growth of 3%, real GDP year over year 0.5. So do the math. You're talking about real per capita economic activity, negative 2.5.
So that may be a little bit tough for a lot of people to digest, but essentially GDP is the gross domestic output, and when we have immigration coming in at 3%, the people who immigrate here should also be consuming and producing. Therefore, their output should be the same. But when you bring in 3% and the GDP only rises by 0.5, we're missing that 2.5%. So therefore, the GDP per capita is dropping, and we've talked about this before.
So unbeknownst to most people, perhaps the biggest bulls on the stock market, maybe the Bay in Canada, is that the recession in Canada is probably already starting, and I think it's going to accelerate through most of this year. That's the big story.
And
So I do agree with him. And one of the reasons why we may get potential rate cuts is not because they're trying to, fix the housing market or some of these renewals, which again, there could be some merit to it, but we're getting up to the point where we've been papering over our economy with immigration, and clearly it's going down right now as GDP, and we're going to be accelerating into a bad economy, which technically means recession. So by doing rate cuts sooner, it means that the economy is not doing as well, right? So I've always talked about this in the past before. Yes, when rate cuts happen, it may save and bail some investors out or homeowners so that their variable is more tolerable. But when a recession happens, job losses happen.
we do have an interest rate decision later this month. It looks like
probably a hold.
Most on Bay Street are not expecting any change this month, but as we move through the year, there is a growing expectation we'll see rate cuts. But it would seem to me that you would be more in the camp of seeing rate cuts sooner versus later. Is that fair to say?
Yes, absolutely. And, there's something called policy lags, and they work in both directions. And one of the reasons why this recession is going to accelerate in Canada is because we're still feeding off all that dramatic restraint that the Bank Canada put into the system. And I think that to a large extent, the Bank Canada is going to be compelled to take out, we're not even talking about providing stimulus. The Bank Canada could cut rates 150 basis points, and that would just basically get us towards a neutral posture.
We're at like 5 right now, getting us down to like 3.5 is not even neutral, I would say. It's slightly above because their neutral rate was somewhere between 2 and 3.
The economy here is fundamentally weak. It's probably one of the weakest economies in the G10, and so the focus is on inflation, which is a classic lagging indicator. Inflation is going to come down as demand lags supply. I think the Bank of Canada and frankly.
So I'm going to pause there. So what he's saying is that when we look at inflation, it's a lagging indicator, meaning it's information we look backwards, right? So similar to when I do market stats, it's information looking backwards. But when I want to look forward, I need to look at the stuff that's happening right now. So I'll put a chart somewhere up here. We did get a really high inflation print in the last one, which was for December 2023. And the reason we got that is if you look at this chart over here, inflation, and I talked about this in the past before, it's just base effect of what it's going to likely look like. It's the average of the 12 months tied together. And when you roll a new month in, you remove the last month. So when we added the latest December and then we removed out the previous December, you can see that in the chart over here that December was a negative print, meaning it was deflationary, not even disinflationary, it's deflationary. So when you remove a negative number, obviously it looks like inflation went up, right? So I think that's kind of baked in. Now, if you look at the next few months, they're all like decently high print. So I suspect there's probably going to be instances where we'll have disinflation in the coming months, which may give signals for the Bank of Canada to cut rates, or even the bond market does it before them, right?
Not just the Bank of Canada, most Bay Street economists I find very disappointing. Everybody focuses on the here and now. They can't see past the tip of their nose. The outlook for the economy, I think, is one of recession. In recessions, inflation declines. I think that the central bank would be better off focusing interest rates on its outlook as opposed to what inflation is doing right now. We're going to get another print tomorrow. Headlines are going to be filled with what the CPI did. The CPI is reflecting things that happened over the course of the past 3, 6, 12 months. It's not a forward-looking indicator. That's my big problem, not just in Canada, but in the U.S. too. This prevailing.
Yeah, I think we've all kind of gravitate towards looking at CPI numbers and like job numbers way too much because it's just the way it's calculated. It's not necessarily forward looking. And I totally agree with him. And the challenge with the way that, say, the Bank of Canada looks at information is that it's always backwards looking and not forward looking. So they didn't tighten fast enough when they, on the way down for interest rates. And very likely they probably didn't loosen fast enough on the way up as well.
Focus on coincident and lagging indicators, and that's going to get us into trouble. And I think both central banks, the Bank of Canada and the Fed, are going to be scrambling to cut rates aggressively, not eminently because they're like, they're like a deer in the headlights because they missed the inflation. They were all intransitory, and they made a mistake. They corrected that mistake in terms of inflation. Now the mistake's going to be made in terms of economic activity, and I'm saying that not just in Canada, but in the U.S. too.
Sometimes we hear a narrative that if central banks, and let's take ours just as an example, if they start to indicate that it is time to lower interest rates, that especially with our housing market, and we talked about some of the dynamics that have pushed up home prices in this country, that if there's all of a sudden a signal that rates are coming down, that's going to feed into the housing story, and then there's sort of these inflationary effects from that. What's your general take on that?
To me, that's a knee-jerk reaction, really. The Bank of Canada is as restrictive currently on its monetary policy as was the case back in the John Crow era in the late 80s and early 90s. They'd have to cut rates a heck of a lot to kickstart house inflation in Canada again and housing activity. So when
he talks about house inflation, he's talking about housing prices. And I agree. Even if we cut rates right now, like the first rate cut isn't going to make the market go bam, just like that, right? If we were to look back at what we have seen so far, when we saw the pandemic run up, we would need to see pandemic rates of like 2%, 1.5%. We did see rates at 4% last spring, and we did see a run up in price. But I think some of that has to do with pent up demand because 2022 was a really scary time. So I think if we're going to have some rate cuts, it's not going to make the market like go up 10% just like that.
Now, how does that factor in? We're going to, maybe is there going to be really speculative activity because the Bank of Canada is only taking out the excessive monetary restraint? We're not even talking about, the first 150 basis points in Canada, and you can almost say 200 basis points in the U.S., is not even easing. It's not even stimulating. It's just taking interest rates back to a neutral level. So.
And what he means by that is going back to neutral levels. Like, I don't think that's easing, and it won't feel kind of speculative growth that we saw in the pandemic. And I think some investors may have been burned already. And there's now talks about the immigration being capped. So that could be another kind of bear case against Canadian real estate. So again, I don't think the rate cuts are going to spur a huge amount of kind of like price appreciation, but it really depends on the asset class and the inventory at the time, right?
So no, I sort of push back and take a look what are the banks doing on both sides of the border? They're boosting their loan loss provisioning. They're pulling back. Look at the credit numbers in Canada. Like, how are you going to get a speculative move up in home prices when the banks are pulling back on mortgage availability?
So what he is talking about there is mortgage availability, meaning like the credit that can lend out. And because a lot of the big banks have had to increase their loan loss provisions, which is basically, oh, hey, some of these loans are going to fail, so we can't lend out as much because we don't have those deposits. It means that the money that the banks are giving aren't going to be as free flowing as once it was in the pandemic. So it's more stringent, maybe rates are higher, less exemptions. And a lot of that is playing out. I can see it behind the back right now. So that means that if credit isn't as available, that means there's less kind of credit to spend on real estate, which means there could be, call it, dampened demand, or maybe even just like demand that's been pushed down because of, like, call it, some of where the rates are going to be, even if we go back to a neutral level.
So I sort of like, maybe there'll be a knee-jerk reaction, I suppose, but will it be sustainable? No, I think that the housing...
I agree. I think if the rates come down, the excess demand will come back, and call it like, some people are calling 2023 spring was kind of like the bear trap, right? Or sorry, the bull trap. But I would say that if rates stay this way, we'll probably get a peak, and then we'll probably like level off if they stay neutral, right? Because remember, last spring, we came to a complete stop because we got 2 surprise rate hikes by the Bank of Canada.
Story in Canada is in the process of rolling over, and that's going to continue, notwithstanding what the bank's going to do in that first 150 basis points. That is not stimulus, okay? That is just eradicating the excessive restraint.
Let me go sort of the other side of that, because there was a big bank conference recently, and a lot of the CEOs here in Canada said they feel okay, it sounded like, about this mortgage renewal process we're going to be going through over the next couple of years. But what's your assessment, for the sticker shock that some Canadians will get from dealing with these higher interest rates? How do you feel about what's going to actually happen in the housing market going forward, especially, I guess, if the recessionary concerns grow into something like, notable job losses? Like,
right.
What does that mean for that market?
Well, look, we're going to really be stress testing that thesis, okay? Because it's one thing, for example, to be withstanding this gigantic wave of mortgage rollovers when you're creating jobs and when the unemployment rate is flat or going down. That's not the case anymore. We're going to be stress testing these mortgage rollovers in the context of rising unemployment. That, to me, the defining moment for the economy last year in Canada was this, okay?
So the stress test being at 5.25 or the higher of the contract plus 2%. So when a lot of these 2025 renewals came up, the stress test was 5.25 because most of the rates were 1 or 2% plus 2. It was still less than 5.25, right? So they were all stress tests at 5.25. Now, if you go 3 years right now, call it you're at 5.5, you're still a stress test at like 7.5. If the rates drop, call it the 150 basis points right now, and it gets to 4, you add 2, that's still 6%. So we're still like 75 basis points higher than that stress test. But what I think he's probably going to allude to is probably that if in a recession does happen, people lose their job, it doesn't matter what the stress test is. Think about, husband and wife with kids, right? If all of a sudden one of the working parents stops losing their job, it doesn't matter if your stress test at 6% or 5.5% or 0.25%, you lost half your income. You're going to have a hard time.
The labor force expanded by roughly 100,000. What was the employment increase? Barely more than 40,000. There is a huge gap between the labor force expansion and the jobs that were actually being created. What does that mean in layman terms? The unemployment rate's going up. And in fact, the unemployment rate in the past year has gone up almost a full percentage point. You look historically, by the time you're up about a percentage point year over year in the unemployment rate, guess what? The recession's already...
So 1% unemployment is a signal for a recession, kind of how like the yield curve being inverted is a sign of recession. And we saw the yield curve invert a while ago.
Started. Each of the past 8 recessions, only one head fake in the mid-1970s. So what's going to happen with the lag, because this is how economics works, rising unemployment is going to cut into wage growth. The Bank of Canada stays on the sidelines, doesn't cut interest rates, but the servicing burden in terms of the interest payments out of income is going to become impaired just by the fact that a looser labor market is going to cut into wage growth. Okay, so
I don't think you need wage growth. You lose half that income and then it's really screwed. The challenge is like if you weren't renewing at the time, right? Then you could just, kind of continue paying it and scraping by. But if you have to renew and you want to go to a different bank, you have to requalify and you don't have a job. Maybe the banks will send you kind of like a higher rate and you can just check the box and move on and maybe you can carry it, maybe. But if you can't handle that rate the bank offers you and then you lose your job and you can't shop it around, yeah, it's a recipe for disaster.
So that's really going to be the story this year. And especially the Bank Canada.
I think it's a story for 2025, not 2024, because most of them, 2025 minus 5 is 2020. 2024 is more of the 2019 rates, which were coming from at 3.5.
You're in the headlights, staying on hold as wage growth slows, unemployment goes up, and then they'll be scrambling to cut interest rates second half of the year. The longer they wait, the harder those rates are going to fall, John.
So we'll watch those trends. And then on the immigration front, which becomes a very political issue, you're looking at the numbers, and I think there's sort of a question on Bay Street about what level of immigration can Canada's economy withstand, essentially.
Not the current level.
Without these other dynamics, like if there's not enough new housing being built, is this a challenge for the economy going forward? How do you view this storyline?
Well, a smart immigration policy, which we have not had in a long time, is an immigration policy, and I'm talking about excluding the social policy aspects. Got to make sure that the immigration coming in at least pays for itself. Like basically the people coming in, what jobs are they getting? So you're going to tell me that they're going to be employed in value-added manufacturing that's going to improve productivity, bring it on. If we're talking about bringing in construction workers,
please bring in more construction workers so we can build more houses.
Tradespeople that could actually boost Canada's housing stock. I say bring it on. The problem, as I said before, there's nothing wrong with immigration. It's just not paying for itself. We have virtually flat GDP growth, 3% immigration. So the question is for the government, these people that...
So he's using that number as in saying that the people coming in that are immigrants aren't providing the GDP growth that they're expected to, because the GDP growth that they are kind of producing, whether it's consumption or production, is less than the average of kind of the existing Canadians, which makes total sense because if we're allowing a lot of international students into colleges come in, I mean, the real only GDP they can produce is their consumption. And during a little bit, they can work 40 hours, but now they can only work 20 hours. And these are probably like your minimum paying jobs. So they're not going to be very strong for the GDP. But if you bring in, call it like temp workers that have a higher salary, maybe like call it, factory workers, manufacturing or housing where like trades are paid a lot more. Yeah, they can probably like be equivalent to the current GDP per person per capita right now.
That are coming into the country. And we're not talking about refugees or the social aspect of it, okay?
Yeah, that part will also bring down the per capita GDP as well.
From a pure economic standpoint, the people that are coming in, what are they doing once they're here? Okay, because this is an unprecedented divide between what the economy is doing and what's happening on the population side. And the way that you actually measure a country's economic well-being is through real GDP or real gross domestic income per capita. And in Canada, it is decaying at an alarming rate.
So Canada's GDP has been, declining for quite some time now. I think since 2018 or 2019, and the pandemic gave it a little boost, but then it's coming back down, right? So all of this stuff, I think I agree with him. The question really just becomes if we focus on what we mainly talk about on this channel, which is real estate. And like I said, I do think there will be what David Rosenberg is saying, a knee-jerk reaction to rate cuts on the price side, depending on how much inventory is in that certain segment of the market. But then afterwards, unless we see more stimulative rate cuts, meaning call it sub 3%, I don't think we're going to see a giant run-up in price. Don't forget, immigration is slowing down right now. So people are talking about how much pent-up demand there is versus relative supply. And this is why we have to see what the supply level is when these rate cuts, supposedly when they happen this year, are going to happen. So that's why I've been watching the inventory right now, and it's not really moving, right? The inventory is kind of pretty level right now. Not much good products at the moment right now, but I am seeing or the showing activity pick up. But that doesn't mean offers or sold prices right now. It just means people have started their search at the moment. Anyways, I hope this gives you a little bit of idea of kind of the macroeconomics and the real estate side and tie it all together for you. And if you are looking for some help on how to navigate this real estate market, you can book a call with me using the link that's right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one or this one? You know what? Just watch them both.